You've probably heard people say things like, "The stock market is crashing," or "I just made money while I slept." But what actually is the stock market? How does it work? And can you really make money with it? If you've always found investing confusing or intimidating, this video is your moment. We're breaking it all down in simple terms, no jargon, no hype, just clarity. So if you want to finally understand what the stock market really is, and how it works behind the scenes, keep watching. Because this knowledge could change your financial future. At its core, the stock market is a giant global marketplace. But instead of buying fruit or sneakers, people are buying ownership in companies, called stocks or shares. Each stock represents a small piece of a company. So when you buy Apple stock, you technically own a tiny part of Apple. The stock market is where buyers and sellers meet to trade these shares, kind of like eBay for businesses. Some of the biggest stock markets in the world include the New York Stock Exchange NYSE, the Nasdaq, and in Europe, places like the London Stock Exchange. But what makes the price of a stock go up or down? Stock prices are driven by one main force: supply and demand. If more people want to buy a stock than sell it, then the price goes up. If more want to sell than buy, then the price drops. But why do people want to buy or sell? That's where things like company performance, for example earnings, news or innovations, economic trends, interest rates or investor emotions, all come into play. Stock prices are constantly changing because investors are reacting to new information every second. That's why markets can be volatile, full of sudden ups and downs. There are two main ways to make money in the stock market. First is capital gains, buying a stock at a low price and selling it when it's higher. Second is dividends. Some companies pay you a portion of their profits just for owning the stock. For example, if you bought Tesla shares at $100 and they are now worth $300, you've made a capital gain. And if you own Coca-Cola stock, you might receive a quarterly dividend payout, even without selling. But here's the catch: there's always risk. Stocks can go up, and they can crash. That's why it's important to understand what you're investing in, and never gamble what you can't afford to lose. You might wonder, why do companies sell shares of themselves in the first place? To raise money. When a company needs funds to grow, for things like hiring, building factories, or launching new products, they can go public through an IPO, initial public offering. This means they sell a portion of the company to outside investors. In return, they get cash, and investors get potential returns. It's a win-win, as long as the business succeeds. But as a shareholder, you're now part of the ride, for better or worse. So now you know the stock market is just a place where people buy and sell pieces of businesses based on news, numbers, and a lot of emotion. It's powerful, it's risky, and it's one of the most important parts of the modern economy. If you want to dive deeper into how to invest wisely, or explore the difference between stocks, ETFs, and crypto, make sure to like, subscribe, and hit the bell. The more you know, the smarter you grow. See you in the next video.